want to thank all of you for being here tonight at this late hour. It's been a long day, and we're happy to be a part of this amazing day. We've got to meet a lot of you, and would be happy to meet everyone in here today if you have any questions about the subject matter. And we're going to go forward, as Kenya mentioned, financing, as we all know, without money there's no business. And venture capital is growing in importance. It's always been very important, but we see as the highs and lows of the economy continue, venture capital is growing. There are more venture funds that are relocating or locating offices in New York City from other parts of the world. They have never been here before in other parts of the country, and they're starting to locate. So this is a 101 course about venture capital, the process of a venture capital transaction. For any of you that have businesses that are ready for financing at the level of a venture capital fund, it's essential to understand the fundamentals and the basics for how you do it, what to expect, understand the psyche and the mindset of the venture capitalists. They understand the entrepreneurial mindset. And a lot of times, because of anxiety, fear, misunderstandings, entrepreneurs that I represent somehow are fearful of the VC, sometimes for good reason, sometimes for no good reason. And so what I'm going to talk to you about today is what the process is and how you go about handling a venture capital transaction at the early stage, and some key terms and other issues that you'll need to know and certainly be aware of. And you're not going to leave experts in the venture capital world when you leave today, but you're going to have a fundamental understanding of the key elements of what you need to anticipate, and it will give you some knowledge about going forward and to prepare yourself for that day. So without further ado, we'll get into the presentation. Of course, since I am a lawyer, you have to see the legal notice here. This is not legal advice, blah, blah, blah. Okay, you've seen it. And by the way, if anyone is interested in the copy of the presentation, let me know after, and I'll be happy to send it to you by email. As Kenya mentioned, my name is Mitch Shelowitz. I'm a partner with the firm Pearl, Cohen, Latzer, and Zedek, Zedek and Latzer. And the firm has been around for quite a long time. We're international in scope. We have offices in Israel, in Germany. We're opening one in Italy. We have an office in Boston, and our USA headquarters are on 43rd and Broadway. I've been representing companies in investments for more than 12 years on the VC side, both portfolio companies at an early stage and more mature, as well as venture capital funds in investments, and private equity investors, as well as individuals who like to invest in various kinds of companies. The objectives of today's program are really to give you some key insights of how you go to the next step. And the things that we're going to talk about is an overview of the process, some common terms, the essentials of venture capital term sheets, which I'm sure many of you have seen or heard of, but you may not have been able to dig deeply into some of the key elements. And many of them have the same standard framework, but we're going to talk to you about some of the key things that are in there today. The types of documents, the term sheet is one document. That's typically the first document that you see from a venture capital fund if you're going to get an investment. But there are several other legal documents that become part of the venture capital investment transaction that we're going to talk about. And finally, we are going to touch on the key role of intellectual property in building your company and making it attractive to a venture capital fund. Okay, just the roadmap of the program, just so you know. We're going to talk a little bit about the introduction. I'm going to give you some key facts, some interesting things to kind of put venture capital on the map for you from the business standpoint, from where things stand today. A deal, I'm going to give you the top 5, in my opinion, key deal terms that you need to know about. If anyone has questions, I'll be happy to do my best to answer them, and then we'll conclude. Now, today's an interesting day because yesterday, PricewaterhouseCoopers and the National Venture Association announced results from Q1 of Q2 of 2011. Okay, the results are astounding. That venture capital investments increased substantially, 19% from Q1 of 2011. And the amount of money, and this is in the United States, that's been invested in Q2 is $7.5 billion in 966 deals. It's a lot of money. It's growing. The types of companies have shifted dramatically to more internet-based companies, and to the point that investments in internet-based companies is at a 10-year high. There was a bursted bubble about 10 years ago. I'm sure many of you remember. It's all changed now, depending upon the company, obviously, but there's a lot of money, and I'm sure you've seen a lot of the headlines. The investments that we're seeing now are both early stage, Series A, and more senior stage, Series C and D. And for those of you who have no idea what that is, typically when you have a company in an early stage of funding that's looking for financing from outside investors, you typically would have an early stage round that's either friends and family, pulling money together, which I'm sure many of you have been involved with. You may have angels that come in. Very often, both the friends and family and the angels are investing in common equity of the company. And as the company grows and develops the business model and hires employees, and is at the time to approach investors seeking additional funds, they'll typically go to venture investors or other investors and offer various series of preferred equity. And we'll talk a little bit about what that means, but it starts with A. It goes up the alphabet as long as it takes to keep the company afloat before some kind of an exit event occurs, and either that's in the form of an acquisition or an IPO or the company shuts down. So I'm going to give you now an overview of the successful venture deal, and maybe before I do that, I could take just a survey, an informal survey of those of you who are in the room. Just let me know by raising your hand if your company has ever raised capital from a venture capital fund. Anyone? No. So if you have raised money, raise your hand. If you haven't, you wouldn't. Okay, so it seems like it's overwhelming that there's been no one involved. So I'm happy that you're all here, because you're going to know when it's that time, you're going to be prepared. You're going to have your roadmap. So typically, what happens, and again, typical is always relative, but to approach investors and to get an investor or a venture fund interested in your company, the first thing you want to make sure you have is a business plan. And a business plan can take many forms, but typically you want to talk about what your company does, what the capitalization of the company is, and that means who the owners are, how much money you're looking for, what you're going to do with the money, what your market looks like, all kinds of things like that. And you're going to take that business plan and you're going to present it to whoever takes it from you. And you're going to tell them that you want some money. And if the venture fund says, yes, we like you, we want to see what we can do, we want to try to work together, the next stage would be some initial meetings and something called due diligence. And due diligence is, again, it's typically the stage after you've attracted the interest of the investors. They like your company, they like the potential, they see that maybe at the end of the day, they'll make some money. And don't kid yourselves, any of you that are in here. At the end of the day, the investors want to earn money. They want you to, build a company, and they want you to, to do what you've promised or what you've presented to them. But this is a business model for the companies. Their money is their business. So they put that money into companies that they hope there'll be some kind of a significant return on the investment, and a multiple typically of 5, 10 plus on what money they've put into the company. Okay, due diligence is a process where the investors will look at the books, look to see if you have any customers, any contracts, any sales, things like that. They'll interview, if you're the owner, they'll interview you significantly. They'll talk to your co-founders if there are any. They'll try to understand that if you're in a team that can work together, if you have experience in the field that you are seeking to build your business in. And let's say they really like you, they like the business, they see a future, they think they can make some money, they're interested, they'll present what's called a term sheet. Has anyone here seen a term sheet? The term sheet in the venture world it can range, from 1 page, which would be unusual, to 10 or 15 pages. And it outlines the amount of the investment in the company. It outlines what type of stock or other equity the fund is going to get, what type of additional benefits that may be available in the form of something called warrants, any kind of potential profit sharing, restrictive rights, and we'll go through some of them. Once the venture fund decides to invest in your company, they want to make sure that they can control how their money is being spent. So there are going to be controls on that. And this is something that for entrepreneurs, sometimes they're not used to having to seek approval from anyone. But the fact is, you're getting their money. They want to make sure that you spend it the way you told them you would spend it in the business plan.